Hi, Todd VanDenburg here with VanDenburg Capital Management with another Uncommon Sense update. So it's official, Joe Biden is the 46th President of the United States. He was sworn in just a short time ago. I know some people say that it was official once the election was certified, but until he puts his hand on the Bible and says the magic words, it's not truly official. So what do we expect in the coming months and the following subsequent 4 years to the election? Well, sadly, I'm sort of expecting the same thing we got the last 4 years. 4 years ago, there was a really vocal group of people that weren't happy about the outcome, and they were quite noisy for all of the last 4 years. And I fully expect those people that are unhappy about this result to be equally as noisy over the next 4 years. So I wish I could say something was all going to be rosy, and that everybody was going to get along. But while that would be nice if it does happen, we're not expecting it, and we're certainly not planning on it. But that's not what I wanted to talk about. What I wanted to talk about is, since the confirmation of the Biden presidency, the markets have gone straight up, and that's a little contrary to what we had sort of expected, to be honest. We were expecting that because when the Democrats are going to control the House, the Senate, and the White House, there's going to be tax increases, and everybody expects those now. And we thought that as those things actually happen, that publicly traded companies would make less money because of the increased tax rates and the increased tax burden, and that would be bad for the markets. But what happened at the same time is this sort of increased or renewed sense of deficit spending that, there was just a bill passed before President Trump left office. It's about a $900 billion package. And they're talking about another $1.9 trillion package to be confirmed here in the coming weeks. So all in all, over the course of, a month, we may see, additional deficit spending over close to $3 trillion. And that's why we think the markets are reacting favorably. And it's because the markets are looking at all this, quote, free money that's going to be put into the economy in one way or another, and thinking, well, that's probably going to offset any loss of revenue or profits from increased taxation. So generally, we're going to be in favor of that. Now, before anybody gets upset and says, well, the national debt's exploding and, it's all bad, I'm not going to disagree that with our national debt where it is, that's not a good thing for the long-term future. But there's two charts I want to show you real quickly, just to give you some context as to where we sit today versus where we've been in the past. So this first chart basically shows the interest on our debt, which is really the only important part of the debt. If you think about it, if you owe somebody money, as long as you can make the payment, the person that you owe money to really has no power over you. You just keep making your payment. And in the United States, that's called the interest payment on the national debt. So we took a look at the interest payment as a percent of GDP, and the interest payment as a percentage of annual federal revenues. And what this chart clearly shows is that it's been way worse, right? The percentage of interest as compared to our national debt, the gross domestic product, and our annual federal tax revenues in the past have just been a lot worse. So if you think about it historically, while the absolute numbers today are substantially higher as far as our debt goes, really, when you compare it to the overall economy, it's really not anything to be incredibly worried about over the short term. Now, there's a reason that this is happening. And again, this is unprecedented. And this is where the second chart comes in. So the second chart shows our national debt growing over time, but it also shows the Fed funds rate falling. So at the same time that we're signing up for additional debt, the interest rate that we're financing at continues to fall. And in fact, older debt that we had taken 20, 30 years ago, as that comes to maturity and we refinance it, we're refinancing it at much lower interest rates, which means that we can continue to keep our interest payment down while our GDP continues to grow and, frankly, the national debt grows. So, we're not overly concerned about the national debt or the interest on the national debt right now. The Federal Reserve has made it quite clear they're not going to raise interest rates anytime soon. So the interest on the debt, which is our payment, we absolutely have the ability to make that payment for a long, long time. And again, that's why we think the stock market is doing what it's doing right now. It's not concerned about the national debt because it sees that historically, as a percentage of our payment, we're doing okay. So please don't anybody hear from this that I'm advocating, borrowing even more money. I mean, it's ridiculous. In the last 16 months, the federal government will have spent more money than all of the accumulated debt from 1776 until 2009. When President Obama took office, we had a total national debt of around $9 trillion. And the federal government over the last 16-ish months will have spent $9 trillion. It's amazing how much money is being spent right now. And long term, 10, 15, 20 years in the future, will there be, sort of a reckoning with all of this borrowing? There absolutely will be. But for right now, if you're an investor, you got to make hay while the sun is shining. So don't get too pessimistic about the fact that we're continuing to deficit spend. Keep in mind how this looks in comparison to other times in the past, and then you can make just a sort of a value judgment as to when you think it might be time to take a step back. But for us, it's not time to take a step back. We are continuing to put more of our money back to work since we had taken some out in anticipation of the election just to be cautious. And so it's not time to be pessimistic as far as the markets go. People can be pessimistic about the election and about society and all that kind of stuff. That's not our job, and we're not going to go there. So if anybody has any questions about this, I threw out some numbers and showed some charts and graphs, and sometimes that tends to confuse people a little bit. So if you have any questions about this or any other financial matter, please post a comment to this video. Send us an email, however you get in touch with us. I'll try to answer any question that you might have. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.